is April 6th, I think, and it is a Monday, I believe. Losing track of the days here. And today I'm going to talk about, after I review the account and as I review it, I'm going to talk about the margin ratio of the account and where we are in this market cycle here, at least in my opinion, and some of the outlook for the future, as well as why I think things are going to unfold this way. So I want to take into the account. It was a very, very monstrous day today. It's not just $3,292. Actually, it's more than that because Robinhood doesn't count the pre-market action. But if you look at what the account was over the weekend, you'll see it's at 55,900 and it finished at 61,900. So that would be a what, $6,000 difference, and it's only accounting for 3.3 here. So that means I was up over 10% when the market was up about, let's see what the SPY finished at, 6.72. Well, it has some aftermarket gains as well. Let's see what the week performance of the market was, 2.29, and I'm sitting at 5.73. So beating the market on the upside, which I'm very excited about. Finally getting some wins over this market, over the S&P 500. So that's pretty exciting. Another thing that this rally has allowed me to do is to continue to decrease my leverage, right? So I went in a little too hot, recognized where I was at in the stage of the markets, and so I started pulling back. And it's very, very bad to pull back at the bottom of some kind of a cycle, whether it's the bear trap like I think it is right now, or a different type of the cycle in the markets. But you don't want to do that because then you participate fully on the downside and not on the upside. So I was waiting for a bull trap in order to try to deleverage a little bit, and that's exactly what I've done. Notice I'm not going short, right? I'm not bearish, but I'm not increasing my leverage. I'm trying to deleverage, and as you can see here, I'm sitting at 26% margin used right now, for a total asset value of 83,800. Okay, so my account is worth almost 62,000. So you add the margin to the 62,000, you get 83. So I've deleveraged a bit. 26 is a good number, 26% ratio for this stage. I think I would like to reduce it further if the market gives me that opportunity, but you never know. I may have to increase it. Of course, as this number goes down, the margin used in percentage terms will go up, right? So if total market value goes down to, let's say, 40,000 instead of 83,000, which is another 50% down from here, then this margin percentage would be above 50%. All right, it would be like 100%. It'll be a very high number. So because Robinhood needs his money first, it doesn't care about me, right? It's their money, so I have to give them back to them, no matter how much. The margin amplifies what happens in the market, right? So if things are going down, they're going down twice as hard if you're leveraged 1-to-1 there. Okay. Now the account. Let's see what happened today. All right, pretty exciting. Very high up days. The SOV calls are gaining a little bit of ground. So is the GDXJ call. So I have options on silver mainly and the junior miners. Gold has made a run above 1700. It closed above 1700 for the first time, and as long as I can remember, there in 2000, I don't know, 12. So it's been a very long time since gold has closed this high. So that's pretty exciting for the gold bulls. And having the juniors is a really good juniors call is really good right here, as well as the silver calls. Silver is most likely going to follow gold at some point. It hasn't yet. It's just kind of scraping around that $15 range, but hopefully it makes a move pretty soon in order to get me some cash. I did sell one or two silver calls just to kind of raise my cash position and deleverage a bit. So I've done that. Um, in other news, look at just this Apple move here. $1,700 plus 660. That's like over 2,300. Just from Apple gains today. But of course, I'm still down on Apple overall. I'm down 1.35%, and then my call option, although it was up $660 today, I'm down about 560. So Apple would need to, I entered too early. But Apple would need to go quite a bit higher from here in order for me to make some serious cash. My option runs out to June 18th, 2021. So I have over a year for this to happen, and hopefully Apple climbs back over the $300 range for me to make some money off of it. And of course, I own the 80 shares. If Apple does make a run towards 300 sooner, like right now, I'll probably sell like 10 more shares, but I'm not sure yet. Haven't decided until it happens. I don't know how long this bull trap will last. And I'm calling it a bull trap because I think there's some more downside to go, and I'll talk about that right now after I finish with the account here. So a bunch of these funds had some pretty good gains. One of the big positions that I've been speaking about lately, I'm sitting at 4.73% of my account is just from O. It only was up 7% today, a little bit less than the market, I think, but I'm really happy that I own this company. I've definitely added some more shares, quite a bit more shares. I have 85 shares now. This will go back to its former highs. I'm pretty confident. I don't know when, but it will. This company will survive this downturn. If it goes up to the $80 range, that's basically double of what I have here. It's gonna go up to $8,000 worth of value. But I'm never gonna sell this, I don't think. I'm just gonna collect the dividends, which actually now with the price of the company so low, the dividend is looking massive. And this company has never actually cut its dividend. This will be the first time they cut, if they do. As long as, I think, for many, many years. Like 20, 30 years or something like that. It's an extremely long period of time. So I'm very happy to own it. And I think they won't even cut their dividend through this process because their tenants, as I talked about in a previous video, the tenants are things like Walgreens and 7-Eleven, which are chains that are open during this, virus pandemic time. So very happy about that holding. And let me see further down. I had to sell some of the Royal Caribbean. I don't think that snapback's gonna happen. It's gonna be a very gradual return to normal here. For reasons I discussed in the previous video log there, that I think that people are gonna still be very indebted. They're gonna minimize their discretionary spending for a long, long time, and so I don't see this economy kicking into the highest gear just yet. Maybe for another few years even. So I'm looking to get out of the Norwegian cruise liner as well, but not yet. I'm hoping for a bigger bounce here off the lows. So SBRA, I've pre-sold 100 shares of that already on May 15th. So if it doesn't reach $15, I will get to keep my 100 shares, but if it reaches 15, I'll be selling 100 and I'll keep just 70. SBRA is a healthcare REIT, just like it says right here. Okay, I think that's about all the discussion. I also lessened the position of Southwest. I think that recovery is going to be pretty slow as well. And even if they do get help from the government, it's going to be quite some time until they're making that, the money to pay their dividends and stuff like that. Even though price to earnings right now is sitting at 7, that's the earnings that are old. And this PE ratio will correct as soon as the new earnings come out for the next quarter, which are going to be miserable. So moving on, when I talked about the margins, I talked about the total account, how it works. review of my position. I'm really happy about I didn't talk about Cameco yet. What happened with Cameco here is it's a uranium company. If for those of you that don't follow the video logs, it went up 4%, and I've just been selling calls against Cameco lately. I've already committed 1,000 shares, so that's like $8,900 worth. I've already committed to selling it at various prices. Sometimes most of them at 10, one of them at 11, one of them at 9. So I'm gonna be getting rid of a lot of these shares. But if you remember, look at my average cost here is 9.57. I've been making money on this company from its sideways movement for very, very long time, right? If you go back to some of my first episodes, I started taking advantage, maybe not first, but like 30th or something, of chemical sideways movement, and look how sideways it's been for the last like 3 or 4 years. So I've been selling puts and calls all this time here, taking advantage of the zigzag, and I expect that to continue for quite some time. So that's what's going on with Cameco. I'm going to leave 500 shares just in case there is a boom in the uranium market, and I'm able to take advantage of it. So speaking of uranium, I also hold two uranium companies who I have without selling puts and calls against, which are not trading at a very high price, but they're not crashing down precipitously either. Um, so we'll see what happens. Energy Fuel was as high as 3.64 here when there was speculation that there'd be regulation to incentivize U.S. uranium producers, but it didn't really materialize. So I'm stuck here with 2,500 shares, and I'm going to hold them until the uranium bull market, probably, which eventually must happen. Well, most likely will happen, in the next 10 years. And I want to be able to profit from it. In the meantime, we'll just bleed a little bit of money, and that's it. Okay, so that's the account, $62,000. And I'm starting to settle into this number. I think there's going to be more downside. I think that people are obviously hyped up about the virus cases, death cases, starting to not minimize, decrease. People are not dying like 1,000 a day anymore. It's more like 800, 700, 500, especially in the European countries like Spain and France, because they just locked down the entire countries, right? Everybody's scared, as well they should be. And so the death toll is starting to get lower, but it's going to be quite some time before we reopen everything. And not just quite some time until we reopen everything, but before people actually go out and start spending like they used to. It's not going to be just a reversion back to the normal, back to what we thought was normal. So that's what defines a bull trap. Okay, after a bubble, initially when there's the initial down spike, like we've had of 30% or so, um, people get hopeful that things will return to normal soon. But all the underlying decay is not really evident. Okay, it's like when you lift, when you see a little bit of a problem there, and you know that the wood has been wet on the deck, and on the surface on top it looks okay, it looks a little bit damaged, but then you lift the board and you just see all the decay that's underneath, right? You see all the mold and missing wood and how fragile it actually was, how close to breaking it was. So we're not going to see all the decay in the economy until later, until when we start lifting off the boards, right? When people start settling bankruptcies, when when the evictions and stuff like that start to happen, when companies start going bankrupt, individuals, when families start getting torn apart, and when life just gets really tough and businesses start shutting down after being hopeful, and loading up on a bunch of debt that they'll never be able to repay because the business will never be as strong as before. So all these companies are going to fail, small businesses, big businesses are going to fail, and that's just going to start to unravel, over the coming months. And even though the market's hopeful, I think that reality is going to bring it back down again for at least a second retest of the lows here. I think we're gonna even break the lows for a few months. But I'm speaking in real terms, right? That's the difference. I think in real terms that should happen, okay? And I think I'm pretty confident that will happen. But we have a twist, right? There's a twist here, which is the Federal Reserve and all the extra money that's been created and just sprayed, pressure gassed into the markets, not necessarily the economy, but into the markets themselves. They've never been more juiced, right? So we have all kinds of programs, names of programs that I don't even know, how to pronounce. I mean, I do know if I can read them out loud, but I'm just kind of exaggerating. Um, and all these like repurchase programs and lending facilities and operations and all kinds of crap that the banksters are doing right now to keep the markets propped up because a lot depends on the markets, right? If they go down, I mean, there's going to be so much destruction of the current infrastructure, at least capital infrastructure of the whole entire civilized world, that it's going to set us back like I don't know how many years. Whether or not that's for the better or not, I mean, I don't know. That's up for you guys to decide. I really don't know if it's better for just to let the old fragile structures collapse or keep them suspended in order for us to continue living, in fairly high standard. So I don't know what the answer is. I don't know what the right thing to do is. I'm just trying to observe what's been going on and trying to position myself correctly. And even though I'm bearish, right, on the outlook of the actual economy, um, the nominal value of this market, I think, is going to be sustained. And that's why I have basically all bullish positions. And I've had all bullish positions for like the last week. I've been talking about this battle between, the downward forces of the real world versus the upward price pressures. Let's not say downward and upward price pressures of the central banksters, and that battle will continue. And I think that because they have control, they meaning the central banks have control of the nominal price of things, they will prevail. But in one way, in the nominal way, but the real world has control of real events, and the real world will prevail, of course, in reality. Peace out.